Joining us right now with his take on the tech sector is Matt Orton. He's the chief market strategist and portfolio manager at Raymond James Investment Management. Good morning to you. Where are we in this tech story? Because so goes tech, so goes I think maybe everything, but maybe I'm wrong about that.
Hey, good morning, Andrew. And I think we're seeing more of that bifurcation. When you look at the price action that we had yesterday, it was very, very challenging in tech and specifically the semiconductor trade. But the broader market still had more upward movers than downward movers. You saw strength in the healthcare space. Financials were doing well. So there's a lot of stuff that is still working in this market, despite some jitters that might exist around technology. And rising interest rates don't suddenly make technology a bad investment. I think what the market is doing is it's finally starting to suss out and ask questions more around, can these companies actually sustain the amount of debt that they're issuing? And it's looking more discreetly at who are the winners and losers going to be. And I think it increases the importance going forward of owning higher quality, high free cash flow generating assets, particularly the beneficiaries of all of that spending, as opposed to, say, the spenders themselves. So there's still opportunities in tech and outside.
Give me some names of folks you went in on, and give me some names you want to stay away from.
So I think the hyperscalers in general are areas I wouldn't not own in a portfolio, but it's not where I'd be putting my marginal dollar. So Taiwan Semiconductor is one of my favorite names right now for portfolios because it's sold off during the month of July, but all roads lead back to Taiwan Semiconductor with respect to this build out. And despite their CapEx plans, we continue to see incredibly strong revenue growth month over month. And they are the only game in town with respect to the most precise chips that are being made. Other names that I think make sense, Andrew, in a portfolio, look at a Welltower to perhaps complement your information technology exposure. It's a healthcare REIT exposed to an aging demographic that we know is growing in the U.S. and continues to increase their margins by making smart acquisitions, shedding some medical office spaces, and really catering towards full service, vertically integrated senior housing. So that's a name that I think is a great ballast to, say, information technology.
One of the questions is just how wide do you think, what kind of transition we have, not just from tech, but sort of the rotation that's taking place, and how much of a rotation you think ultimately is going to take place?
So we've seen this rotation of starts. It's had fits and starts. And I really think there is sustainability to what you're seeing with respect to strength in the financials area. You've seen really, really strong growth across the banks, in particular capital market companies. There is durability there, and there's durability on a global level to that area. I think healthcare is a more challenged space. Earnings growth for this past quarter were actually negative, and you have to be specific. Pharmaceuticals, biotechnology, healthcare REITs, those are perhaps areas that I may think make sense. HMOs, which have done well, I think there's still question marks with respect to that business going forward. So perhaps that's an area to avoid. I think rising rates might challenge utilities a little bit. We've also seen some questions with respect to data center connectivities and states pushing back. So it's selectivity is what's going to be really, really important in this market going forward. And my favorite sectors are tech, financials, and industrials, and not just AI data center industrials, Andrew, but also your more cyclicals, your railroads, your trucking companies. You've seen an inflection with respect to earnings, and financials are corroborating that with really strong commercial and industrial loan growth.